Hey, it's Joe Crump. Welcome to my brand new video series. I've been getting so many emails and questions from people on my list, from investors on my list, that I felt that I should address it in a bunch of videos. So I'm going to create a bunch of short videos that you can watch and give you an idea of the new things that I'm doing. We've added so many new automation techniques, outsourcing techniques, and ways to make your business more efficient so that you can put in less time, make more money per transaction, and eventually get yourself into a position where you can actually separate yourself from the business and have it run on its own. So these are some of the the cutting edge techniques that we've been developing myself with my mentor students, and I think you're going to be pretty excited by them. I'm going to start with just do a question at a time. I'm going to start with this first video with a question, and it's from Eddie Jamison from New Haven, Connecticut. His email says, "Hi Joe, I understand that you're now doing transactional financing on real estate deals for people who partner and mentor with you. Can you explain how that works?" Okay, first of all, let me tell you what transactional financing is not, because there's a lot of people that are talking about this on the internet, a lot of real estate investor teachers that are talking about this on the internet right now. They're making offers. There's a lot of hype surrounding this concept and what it can do, and there's not much information about what it can't do. So let me get into that with you here. Yes, first of all, I am offering transactional financing to my mentor students. So that means if you find a property that you want to buy that's really dramatically under market value, that you know you can turn around and flip and make a chunk of money on, but you don't have enough money to do it, I can help you do that. Now let me tell you what it's not. It's not hard money loans. I'm not a lender. I'm not loaning this money to you. Transactional financing is where you identify the property. You need a letter of credit on that property. You need to prove that you've got funds. So I provide that proof of funds so that you can give that to a bank, REO, individual who's selling the property, and you can prove that you've got the money to close the deal. Then you can go out there and you can find yourself a new buyer for that property at a higher price, and we can have two closings. Essentially, when that person's ready to close, that same day I come in with the cash, I close the deal, and then we go right next door and go to the next closing, and the new buyer brings in his money for the loan and pays off that transactional financing. So it made it possible for you to give proof of funds, made it possible for you to buy the property for cash, and it made it possible for you to turn around and sell it to a new buyer. Really fantastic, and in theory it's very exciting, and I know that like I said, there's a lot of hype around this. There are some things that you need to watch out for, and there's also two ways to do this without using transactional funds, because transactional funds are expensive. You're going to pay, on hard money loans, you're going to pay 10 points plus 18% interest on these things. On transactional financing, you're going to pay 10 points as well. A point, by the way, is 1% of the loan amount. So if it's $100,000, you're paying $10,000 for this money. So you've got to buy it dramatically under market value. We're looking 40, 50% under market value, which, right now in this market isn't that difficult to find. There's a lot of great deals out there, and then you can turn around and sell it for 80% of market value, still give the buyer a great deal, and make a $20,000 or $30,000, $50,000 yourself. And in higher end markets, even more than that. So there's some really interesting things going on with this type of financing right now, and it's very sexy. Now, but there is ways to do it without using this transactional financing. You can do it with a simultaneous closing. Simultaneous closings essentially is the same thing, except the title company is willing to use the money that's coming in from the second transaction to pay off the first. I've done these many, many times. It's become a little more difficult to do them these days than it was in the past. So that's one of the reasons transactional financing would come in handy in some cases. The other way to do it is through an option. And I've done options on hundreds and hundreds and hundreds of properties. It's one of the main structures that I teach. I did it with a bunch of new construction just in the past few years. Now, it's not a viable technique for new construction right now because of the cost of new construction. But when we were doing it, essentially what I would do is go in and make an option on an entire subdivision from a new builder, and I would make the option at a specific price. Then I would go and turn around and sell it to my list, still at a discount, but for a little bit higher money. And then when they close the deal, I would get the difference between the purchase price and the option price. So I'd make money doing it that way. So you don't have to have transactional financing to do it. But there are some situations that require that you show a letter of credit. I had a relationship with those builders, so it made it easier for me to do an option, and I could work with them. You're not going to have that all the time if you do it with REOs. Now, here's another problem with transactional financing. If you go in and buy a property that's listed on the MLS as an REO, and let's just use the number, it's listed for $100,000, it's worth $180,000. And you can go in there and buy it for $180,000. You've got a buyer who wants it $150,000 he's going to give you for the property. So you go in there and you're planning on using transactional financing. You show them, my letter of credit or my proof of funds to show them we got the cash, we can close this deal. Then we go out and we find another buyer. That buyer says, yeah, I'll pay you $150,000. He goes out and tries to get a loan to do that, and the lender looks at the MLS, or the lender's appraiser looks at the MLS and says, no, this property is being sold for $100,000 right now. We can't appraise it for $150,000, even though its value may truly be at $150,000. And so the lender won't give the loan. Now, if the buyer is a cash buyer, then that's not a problem at all. But if they're using a new loan, then it could be problematic. I'm not saying that's going to happen every time, but it could happen sometimes. So it's something to be aware of. Same with options. So anyway, whenever you're dealing with a lender and you've got a property listed at a specific price in the MLS, the multiple listing service that an appraiser has access to, then it could be a problem selling it for dramatically more and getting it appraised for that amount, even though the value is there, because they're seeing another person buy it for so much less money and taking a big killing at that, and they feel like they're making a bigger risk because they're taking that at a higher price. So that's the reason that the transactional financing is going to work the best on private individuals. So if you go out and find people, and I've got lots of ways to find great deals on properties from private individuals using our expired campaign, our absentee landlord campaign, the standard stuff that we use with signs and the FSBO campaigns that we do to find properties that are dramatically under market value from individuals rather than from the MLS. So the appraiser won't go to the MLS and see that property in the MLS for dramatically less money because you're working with a private individual. So it makes it possible to do that. So transactional financing, we do have it. It's a phenomenal thing for the right situation. The thing is, when you're an investor, you want as many tools as you can possibly have, because it'll make your options greater. I give you all those tools, or at least I give those to the people that are my partners. Those partners are the people that are in my 6-month mentor program. So if you're interested in getting involved in it, you ought to take a second look at the mentor program. I'd love to have you. I'd love to talk to you about it. Anyway, till next time, we'll come up with the next question. Thanks. Bye-bye.